Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning. This is Quincy Krosby, and this is Monday morning, July 11th. It's The Talking Point. Thank you so much for joining me. This is one of the busiest weeks that I can remember in the market, especially a market that is focused on earnings and a market that is focused completely on inflation. And why? Because we want to see what is the Fed thinking. And remember what the market really wants. It wants to get a sense of when the Fed is going to be ending its aggressive campaign to fight inflation. But before we get there, I want to mention something regarding the labor report that came out on Friday. The labor market remains solid. Is it stellar? Not necessarily, but it is solid. And you don't have examples of recessions or deep recessions when you have a strong labor market or a solid labor market. But there was something else in that report, I think, that gave the market a sigh of relief. And that is we did not see hourly wages climbing higher. Let's remember the role of hourly wages. When we look at that, we know that when hourly wages start climbing higher, what do companies do? Well, they raise their prices. And when they raise their prices, they hope that the consumer or a business is going to pay the higher prices. That's how you get inflation. When it's really bad and wages are skyrocketing and the prices go up, it's called a wage price spiral. And so what we saw last Friday was that for 3 months in a row, wages stayed the same. Didn't go down, but they didn't climb higher. That is good news in terms of how we view the fight against inflation. Now, I have to say this because it always sounds awful. Well, Quincy, don't you care about the average worker? Sure, I do. But our job is about the market and about the Fed. And so the Fed wants a slowdown. They've said it. They want to see that we stop spending. They want to see that prices come down. They want to see inflation coming down. And that's how we have to look at it. Sometimes if I mention this, kitchen table economics in my own family and say, this is really good news that wages aren't going up, I will hear back from my family at the table, you're so mean. Now, right now, I'm just looking at it the way the Fed looks at it and the way the market does, okay? So what we want to see is wages coming down a bit. We want to see fewer job openings. Why is that? Because the less you have, people can't go out there and fight, and say, gee, I could go get another job somewhere else. We call that the quit rate. We watch that very closely. They will take wages at a lower level and not fight for more, or these signing bonuses. Again, that sounds so awful when we talk about it, but remember, we're looking to bring down inflation so that the Fed can be finished with its aggressive campaign. This week, we're going to have an awful lot on inflation, more than we can stand, because at the same time, we're going to be hearing about earnings. So to begin with, just tomorrow, is the National Federation of Independent Businesses. This is the Small Business Survey. This is one of my all-time important favorite data reports. Why? Because our country is based on small business and mid-sized business owners. How they feel, what they say about future sales, what they say about future hiring expectations is important, because one of the things about this report, we know that probably the most important thing for the small business owner is expectations of higher sales or lower sales. They will stop hiring and they won't buy equipment. You'll start to see, no, we're not going to spend as much because we don't expect sales to move higher. So this is tomorrow on Tuesday. And then on Wednesday, we get, yes, the CPI, the Consumer Price Index. The expectations here are that remember, core inflation does not include food or energy. No, it does not. The expectations there are that may have leveled off, although there are concerns that rents may have climbed higher, even though we know that there are some pockets in the country where rents have started to recede. We also know that in other parts of the country where folks are flocking to for jobs, that rents are higher. So this is going to be an important report. When you start looking at the headline report, this includes food and energy. Remember, it in May, it was 8.6%. That includes food and energy. We know that energy prices have come down, but whether or not it hits for this particular report, which will be June, we will wait to see. Food prices are higher. There's no doubt about that. But what we want to see is a leveling off. We don't want to see it climb higher, because if it climbs higher, the Fed says, gee, our medicine is not working. We got to keep at it. So this is going to be an important one on Wednesday. In terms of inflation also, today we're going to have a 3-year inflation expectation report coming out. And that is a report from the Federal Reserve Bank that takes a look at what expectations are 3 years from now. Again, important. You don't want it climbing much higher. You don't want it climbing higher at all. You want it to level off and go down. On Wednesday, after the CPI, Consumer Price Index report, we'll get the Beige book. This is an important report. People make fun of it because they don't like the name, the Beige book. It comes from the Federal Reserve banks across the country. And the reason it's called Beige, I know it sounds so dull, right? That's how it came out years and years ago. They never changed the name. But why is it important? It's important because it's a fairly up-to-date report that comes from the Federal Reserve banks across the country, and where they go out and talk to business owners, small business owners, large business owners. What are they seeing? What do they think is going on with inflation? What do they think that's going on with the direction of sales and top-line revenue growth, and so on? It comes out in this report, and especially in an environment that we're in now, where we're so focused on, one, inflation climbing higher, prices going up, and also whether or not the slowdown that has been engineered by the Federal Reserve leads us into a recession. So this is why the Beige book is so important. And then on Thursday, we're going to get, again, another look at inflation from a different perspective. The PPI, the Producer Price Index. What do things cost in production? Because ultimately, those higher prices that manufacturers, that the service sector has to pay, goes into the final price. So that will come on Thursday, all related to inflation. On Friday, we'll get the retail sales. Now, you know this is important. One report will be without auto sales. The other will be with auto sales, because the U.S. consumer, 70% of our economy. And what we want to see is a slowdown in sales. Have we slowed down? Remember, that's the goal of the Fed. The more we slow down in spending, the more companies, retailers have to lower their prices, maybe even give us bigger discounts. So that's why it's important. So far, by the way, we see that the higher wage earners, who are responsible, by the way, for a large portion, about 40% of retail sales, are still holding on. They've got cash. If they're in the stock market, their portfolios are lower, but they do have cash still. And we're seeing whether or not their spending is continuing to hold. We know that the lower wage earner is really under pressure in terms of their necessities, food, and at the pump. So we're going to see a breakdown, and we'll see what we're spending money on. On Friday, also, we'll have industrial production, and you could obviously see why that's important. And here's another one that we're going to look at for inflation, the University of Michigan Consumer Sentiment Report. We know that consumer sentiment is down. Every reading of what the consumer feels is down. But in that report is what we call the 5-year inflation expectations. And this report is the report. This is, by the way, this is the preliminary report, not the final report. But this is the report that actually, coupled with the CPI report, Consumer Price Index report, that got the Fed to move from 50 basis points to 75 basis points before the Federal Reserve meeting. Remember that? We all expected 50 basis points, and ultimately it was 75. This was during their blackout period that they got the message through. And what happened? It was the 5-year inflation expectations, where American consumers saying, we see inflation higher in 5 years. Good news on this is that when the final report came out, The consumer inflation report for 5 years was back down. So we need to see it's moving in the right direction, down. It may level off, which is good news, but what we don't want to see is that it has climbed higher. That's important, the trajectory. Also this week, earnings. Earnings. We are going to have the banks, JP Morgan, Morgan Stanley, Wells Fargo, Citibank, PNC. That group of banks represents all different perspectives on the economy. Everything from mortgages to loans, small business owner loans, corporate loans, individual loans. We'll get a picture of lending. We'll also get a picture of whether or not any of these banks are seeing defaults, potentials for defaults. That's going to be very important. But we'll get a broad picture of how they see the economy, and also on their earnings calls, they will be asked, what are your customers saying? What are your clients saying? And that's going to be important. More than ever, the guidance coming from the earnings reports are going to be important because the market looks ahead and wants to see how they see things over the next quarter. So this is going to be a very important week for earnings. By the way, it won't just be banks. We're going to hear from PepsiCo. And, this is important because we'll see, are folks buying, what do we call snack foods, and how are they doing overseas? We'll also hear from Delta. And obviously it's going to be important because Americans are flying. Are they seeing that because of those really high ticket prices, and not to mention cancellations, are they seeing Americans starting to slow down travel? And some of that has to do, of course, with schools starting in the fall. But we want to hear what they say. It does give us a picture of consumer spending. Right? We know we're going from durable goods. We're not spending much on the refrigerators and the washing machines and so on, but we are spending still on services and going out and experiences. So that's what we have this week. It's going to be an important week for the market. Now, look, this market has had a nice move higher. The S&P is up about 8% from the low. That's good news, but people always want to know, is this the end of the bear market? We won't know yet. But one thing I can tell you, when we shift to, and it's a process, to a bull market, one thing about a bull market, when it begins, it moves up with tremendous momentum because the market sniffs a change that's coming, an important change that gets us out of the bear market. And the momentum is strong. And that's what we look for, sort of strong momentum. And so far, we haven't seen that in terms of momentum, of surge, of a mentality that says, hey, you know what? We're getting out of this. It does happen. We get to it, and we're going to see this week whether or not all of the data together and also the earnings and the guidance give us more optimism that we're closer to the end of a bear market. So this is going to be important. The expectations from many of the analysts, by the way, are that we are going to hear, our margins are lower, operating margins are being pressured, top-line revenue growth is down, earnings are not going to be that great. That's the bear case. The positive case on this, from many analysts, by the way, is, no, we're holding on, we're doing okay. So this is going to be important. It may be specific to each company, stock specific, but nonetheless, we're going to get a good read from the banks and again, the airline and PepsiCo. So important week. Please don't hesitate to get in touch with me. And by the way, if you're having trouble hearing me, good news, somebody got in touch and said, Quincy, it breaks up. They're getting me a microphone. So stay tuned, everybody. Thank you so much, and get in touch. Email me, call me, whatever. I will be back to you. Thank you again. Have a good week. Stay good. And thank you very, very much for what you do with your clients. Take care. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.